And welcome to live virtual revisionary classes from the Board of Studies. Today's from paper 4, which is direct tax laws in international taxation. Before we get started, I am CA Kriti Chawla and I shall be taking up these four topics for you guys. So today we will be talking about chapter 25, which is fundamentals of BEPS, which is base erosion and profit shifting. So today we'll start with talking about what exactly is base erosion and profit shifting. We'll also be talking about chapter 26, which is application and interpretation of tax treaties. So double tax avoidance agreements, DTAAs, which are also called as tax treaties. What exactly are these? How do you apply them? How do you interpret them, etc.? This is what we will be covering. We'll also be covering chapter 27, which is overview of model taxation conventions of the module. So our purpose for today, our objective of today is to cover these four chapters for the purposes of paper 4. How I have actually structured this particular presentation is to start with international taxation first. So we will be talking about basics which are relating to international taxation. And this is what is part of chapter 26, which is application and interpretation of tax treaties. Now, after we discuss, this concept on residence and source based taxation and the basics of international taxation, we will be talking about tax treaties. So I'm going to take the flow in a very logical manner, and then we will be talking about tax treaties or double taxation avoidance agreements. From there we will be talking about all the articles of the model taxation convention. I will also be introducing the OECD and the UN model taxation to you guys. After that, we will be talking about, after that we know and we have clarity on international tax concepts, we will be talking about BEPS, base erosion and, profit shifting. Um, um, this is where I will be talking about what was wrong, why did BEPS came into play, and the all the action plans of BEPS. After that, we will revise through the action plans, the different action plans that has been introduced by BEPS. And finally, we will be talking about the latest developments in international taxation. Our primary focus, as far as the latest developments is concerned, is going to be on this two-pillar framework, which has been introduced as part of Action Plan 1. So this is what we will be talking about. And this is where we will be finishing up with these four chapters and revising, with the same. So yes, without any further delay, let's just get started with describing the problem area because of which BEPS came into place. So what I've done is, if you look at this particular slide, this is a few pictures that I've carved out and put together in this particular slide, and this is the picture that signals that there is something wrong which is actually happening. So if you see, these were, the GAFA companies right here, and there was something wrong in, this particular picture. If I ask you, what is that one word which you see, which is, the problem area right here? So the answer is, okay, I'll give you 1 minute to look at this particular picture, and then I'm gonna, talk about what is the problem in this particular picture. So just take a minute and, just see through this picture. Okay, so if you look at this kind of, picture, it was actually in 2021 that there were $500 billion that were actually lost to tax abuse by firms and the super rich. Now, this amount of money would have been enough to vaccine the global population against COVID 3 times over. Just trying to give you a little perspective on the amount of, money that was actually involved. If you look at this kind of picture, there are two things that might come to your mind. There could be something called as tax avoidance, and then there could be something called as tax evasion. Now, if you look at these two terms, the motive of these two terms is actually avoidance, is actually minimizing the tax liability. Now, the thing is that one does it in a legit manner and the other does it in a manner which is sort of illegal. So if you look at a concept like tax evasion is minimizing the tax liability for sure, but it does it in an illegal manner, forging documents, coming up with deflating the income or inflating the expenses through an illegal manner, etc. That's basically tax evasion. The point is that for tax evasion, it is punishable under the act, under the domestic laws of a particular nation. It's punishable under the Income Tax Act of 1961. Or there could be imprisonment, there could be fine, there could be penalty, etc. as far as tax evasion is concerned. Now, if you look at this kind of picture, it signals something called as tax avoidance. Tax avoidance strategies also help to minimize tax liability, but they do it in a manner which is, sort of legit. It does it in a manner which is not punishable under the act so much, but it is more like a crime against the society. So if you see this picture, there was a lot of protests that actually happened to close these tax loopholes, to close these tax avoidance strategies. And this is where they came up with some action plans which were called as the OECD BEPS action plans. But to go into BEPS action plans, we should read about some basics that are actually involved right here. So the first basic terminology before we actually jump onto BEPS and we come to international tax, the first basic methodology right here is something called as residence and source based taxation. Now, the point is, what is residence and source-based taxation? Well, if we take a step back, there is something called as connecting factors in international tax law. Now, the thing is, what is this connecting, factor? Well, who has the jurisdiction to tax? Is it the country where there is residence, or is it the country where there is source of income which is situated? Which is the jurisdiction which has the which is the jurisdiction that can actually tax a particular income? That is called as a connecting factor. So the taxability of a foreign entity in any country, it depends on two factors: whether it is doing business with that country or it is doing business in that particular country. So that is basically called as connecting factors. And there are two connecting factors right there, which is called as residence and source. It basically means that a company can be subject to tax either because it is resident in a particular area or a country or a jurisdiction, or because it has some kind of source link with that particular country, as in it's deriving its source of income from that particular country. So where is it being taxed? That is basically called as connecting factors. And precisely we need to find out where a particular income is being taxed. It is being taxed in the residence country, or is it being taxed in the source country? This is the reason there are two basic principles that are followed by different jurisdictions in international taxation. And these are called as residence-based taxation, and then there is something called as source-based taxation. Now, the point is, what is this residence and source-based taxation? Well, we look at first residence-based taxation. Residence-based taxation basically means that if you are resident of a particular jurisdiction, then that kind of jurisdiction gets the right to tax that particular income. Like in India, if let's say an individual, as an example, if an individual in India becomes a resident of India, then their global income will be subject to tax. So whether they're earning income in India or whether they're earning income outside India, it's going to be taxed in India. Similarly, for a company, wherever the company is a resident, their global income will be subject to tax there. So if a company becomes a resident of India, their global income, whatever profits that are being derived in any other, jurisdiction, they will all be taxed in India. So this is the reason, if you look at, residence based, taxation, this is the reason they say that it instructs a country to tax person if they are resident or if they are domiciled in that particular country, regardless of, the source of income. So under the residence principle, a state's claim to tax income is based on its relationship to the person who's deriving that particular income. Okay. Now, a state can typically, it can have some degree of power to compel tax payments from its residents. But then what is very important is that it should have some reliable information about the amount of income that they have earned. So, how will you know that, let's say if a particular company is a resident of India, how will India know that what is the amount of income that they have actually earned, in the UK for that matter. So for that, what we have is bilateral tax treaties. And these particular tax treaties, we will be, reading about these tax treaties in a lot of detail. But these tax treaties, they actually contain an appropriate exchange of information provision. What is this exchange of information provision? Well, we'll read about this in a lot of detail, but these are, provisions, or these are articles in a particular tax treaty that will help two countries exchange information. Or there could be a multilateral, agreement on exchange of information for tax purposes, and that will precisely help a state in determining the foreign source of income for its residents. So there could be a lot of mechanisms that could be in place to determine residence of a particular, individual, to understand whether there is residence-based taxation or not. If we talk about the domestic tax law of India, there is Section 6, which basically says that, an individual becomes a resident in India if they spend 182 days or more in India. So that's very, very important. Then you could actually look at Section 6, subsection 3 of the Income Tax Act, and there they talk about, residence-based taxation for a particular, company. And they say that if a particular company is incorporated in India, it becomes a resident of India. Or, if their place of effective management, if the place of effective management of a particular company, is in India, then it's going to be a resident in India. What I'm really trying to say is that the moment a particular individual or a particular company becomes a resident of India, then their entire global income will be subject to tax in India. And that's basically a residence-based taxation. Now, the next thing is something called as source-based taxation. Now, in case of source-based taxation, the importance is provided to the source country where income is, generated. Let's say that there is, a foreign company and they're making profits from sales to customers in India. Now, the foreign company should it be taxed, in India or not? Well, that is the question. Well, this is called as source-based taxation, and India will say that, listen, you have earned, income because of sales in India. You have interacted with users in India, and this is the reason you're making, profits. So you ought to pay tax in India. This is called as, this is called as source-based taxation. Similarly, there could be a US citizen, and a US citizen has, let's say, a house property in India. This is from an individual perspective. So if a US citizen has a house property on rent in India, and they've given this house property in India on rent, and they're earning rentals in INR in India, this is where India will say that, listen, you should be paying taxes in India on the rental income. Why? Well, that is because, you have your source of income is in India. You have the house property, in India, and that is actually helping you earn, rental income. So you should be paying taxes in India itself. This is basically called as source-based taxation. So, the states claim, the countries claim to tax income, it is based on the state's relationship to that income. And in this case, the view is that, the country which is providing the opportunity and facility to generate that income or profit should have the right to tax the same. So source-based taxation is generally justified on the ground that, the state has contributed to the creation of that economic opportunity, like, having the house property in India or making profits from sales, to customers in India. And that allows the taxpayer to derive income which is generated within the territorial borders of the state. Of course, the jurisdiction to tax is also about power, and a state generally has the power to tax income if the assets and activities that generated it are located within its borders. So that's source based taxation. The point is that you know what happens if there is source based taxation and there is residence based taxation also. There could be a conflict between residence and source conflict. So I'm going to talk about this one small example right there. Let's take a minute and read through this particular question right here. So the question is that, what happens if there is a, company or an individual which is, let's say, resident in country A, but then they're getting their source of income from country B. Now, the question is, which country gets the right to tax such income? Is it going to be country A or is it going to be country B? Which country has the right to tax such income? Well, this is where you could say that this is going to be country A that is going to be taxing this particular income. Why? Because there is something called as residence based taxation in play. But at the same time, you could also say that country B can tax this particular income because there is something called as source based taxation in play. This is where there could be a collusion of taxing rights or a collusion of taxing principles right here. And this one income is taxed in country A and it is also taxed in country B. This can result in something called as double taxation. And what is the solution? Well, the solution is to have something called as double taxation avoidance agreements in play. DTAAs, double taxation avoidance agreements. These are also called as tax treaties. These are also called as DTAAs, and we will be talking about this in detail. But what has happened here is something called as double taxation. Now, there are two types of double taxation right here. There is something called as juridical double taxation, and then there is something called as, something called as economic double taxation. The thing is that it is only juridical double taxation that can be addressed by a DTAA. Economic double taxation is something which cannot be addressed by a DTAA. We'll talk about this in a lot of detail, but let's see what is juridical double taxation. Let's take an example right here. So let's say that there is an Indian company. The Indian company is resident in India. Now, obviously, because it is resident in India, its global income will be subject to tax in India. Now, what if this particular resident Indian company opens a branch in the UK? Now, the profits of this particular branch will be taxed in the UK. UK will say that there is source-based taxation. You have a branch in, UK. So as per source-based taxation, you should be paying taxes in the UK. Now, this is where India will say that, because you're a resident of India and you have a branch in the UK, your global income is going to be subject to tax in, India. So whether this is the Indian company or it is the branch in the UK, everything is going to be taxed in India. So if you actually look at this particular problem from the perspective of this branch in the UK, that branch is being taxed in India and that branch is being taxed in the UK as well. So there is something called as double taxation, and this precisely is called as juridical double taxation. Meaning to say that if there is imposition of income taxes in two or more states, and this is on the same taxpayer, which in our example is, the branch in the UK, and this is in respect of the same income, which is the profits of the branch, and this is for the same period as well. But this is in two or more different states, which is, let's say India and which is UK. Well, then this is called as juridical double taxation. An instance can be when resident of one country derives income from sources in another country, and both the country's domestic law or domestic tax legislation would tax that particular income. This is called as juridical double taxation. Example, let's say dividend. Dividend is being taxed in the country of source by way of a withholding tax, and then this is taxed one more time in the country of residence of the shareholder by way of a tax assessment. This is basically called as juridical double taxation. And the thing about juridical double taxation is that it can be addressed by a DTAA. So there is something called as a double taxation avoidance agreement or tax treaties, which basically address this particular kind of double taxation. The other kind of double taxation is called as economic double taxation. Economic double taxation is basically taxation of two different entities, and this is often by the same country with respect to the same income. Now, let's say that there is a company which has earned, profits. Now, because the company has earned profits, this profit will be subject to tax in that particular country. Now, after paying, taxes on that particular profit, what is left is the residual profit. The residual profit is distributed to the shareholders as dividend. Now, when the shareholders receive this particular dividend, they will also be paying, a tax out there. So what has happened here is that the amount which was actually left after paying corporate profits, it was again subject to tax in the hands of the shareholders, as maybe a tax on their dividend. This is basically called as economic double taxation. So what has happened here is that there was taxation of two different entities. The first one in the form of a company and the second in the form of a shareholder. This was often by the same country because, the shareholder could be resident of the same country, but this is with respect to the same income out there. So this is basically called as economic double taxation. This is where income is earned by a corporation. It is taxed both to the corporation, which is tax on profits, as I mentioned, and then to the shareholders when it is distributed as a dividend. So it says example is when profit which is earned by the company which paid the dividend may be subject to corporate income tax. Economically, the corporate profits and the dividend are the same income, however, taxed in the hands of two different taxpayers, and which is company which is paying the corporate income tax and the shareholder which is subject to taxation on the distributed profits. So this is called as economic double taxation. Now, the thing about economic double taxation is that you cannot do much about it. That this is generally not addressed by, double taxation avoidance agreements. So this is, something which, just actually, stays. It is not really addressed. But talking about jurisdictional or juridical double taxation, this is something which is addressed by a DTAA, and that is where DTAA comes into place. As I mentioned before, DTAAs are also called as, tax treaties. So what exactly is this concept of a DTAA? Well, this is, the slide that talks about, DTAA. Well, what exactly is this DTAA or this, tax treaty or double taxation avoidance agreements? Well, these are more like bilateral agreements between obviously two countries that help to mitigate double taxation or resolve double taxation. They're negotiated under public international law and they're governed by the principles which are laid down under the Vienna Convention on the Law of Treaties, which is called as VCLT. So if you look at VCLT 1969, a DTA has been explained right there. It says it is an international taxation agreement which is concluded between states in written form and governed by international law, whether embodied in a single instrument or in two or more related instruments and whatever its particular designation. So what we're really trying to say is that it is not like a taxing statute. It is just an agreement. It is more like a bilateral agreement, and this is going to tell you about how taxes are to be imposed. This is going to tell you that how taxes are to be imposed or how double taxation is going to be resolved. But what they're really trying to say is that this is not really a taxing statute. It is something which is governed by VCLT. VCLT is also called as Treaty of Treaties, and this is going to provide in guiding principle for model treaties also. So it is an act between two sovereign states, and whatever are the terms and conditions which are mentioned in the DTAA, they are to be strictly followed. There are two types of DTAAs. There is something called as a comprehensive DTAA, and then there is something called as a limited DTAA. So if you look at, almost all kinds of DTAAs, there are a lot of DTAAs that are actually called as comprehensive DTAAs. Comprehensive DTAAs are something which cover almost all types of income. So it's going to help you resolve double taxation when it comes to, income, when it comes to capital gains or, royalties or business profits or, dividends, whatever. So it's going to be, very comprehensive in that particular, sense. And then there is something called as a limited DTAA. Limited DTAA are very, very limited to certain types of, incomes. They are, let's say, the DTAA that is signed between India and Pakistan. It is actually limited to, let's say, aircraft income only. So it's going to resolve double taxation only when it is to that particular extent. So these are very, very limited in that extent that they will resolve double taxation only when it goes to certain issues of taxability of income. So a DTAA, it could be limited to shipping income, it could be limited to aircraft income, etc. It's not going to resolve double taxation for all those incomes, but just for one or two selective income type. So that is basically a limited DTAA. But you'll have to look at, the DTAA which is signed with each individual country to see whether it is a comprehensive DTAA or it is a limited DTAA. So the point is, what is the benefit of having, these particular treaties out there? What is the need or what is the, benefit of having these particular DTAAs? I know that this is for resolving, double taxation, but is there something more to it? Is there something, like a different need to it for these particular DTAA? For that, just read through this particular, uh, chart that I have provided and we'll discuss it. Well, yes, the first thing is that yes, it helps to resolve double taxation, which is elimination of double taxation. But then it also ensures that there is allocation of taxing rights. So if there is, let's say, a double taxation instance for interest income is being taxed in the resident state and in the source state. Well, then there is a DTAA, and when you look at the DTAA, it will precisely tell you that interest is going to be taxed in the resident state, and the source state will give up on taxing right. So that is basically allocation of taxing rights. It's going to allocate taxing rights either to the source state or to the resident state. Then there could be assisting in collection of fair and legitimate share of tax. So that will precisely help collect the tax by the resident state or the source state. Then there could be resolution of disputes on account of different treaty interpretation. When you look at all the different articles of a particular treaty, you will understand that there is a dispute resolution mechanism also in place. If there is dispute that arises, there is something called as MAP, mutual agreement procedure, wherein these kind of disputes can be resolved. Then there is ensuring non-discrimination between residents and non-residents. So this will actually help you ensure that there is non-discrimination between residents and non-residents, and there are articles for that also. So this is what I'm trying to say is that a tax treaty provides like a holistic approach wherein these issues are also resolved rather than just elimination of double taxation. There is also Article 26 in a tax treaty for exchange of information, which helps countries exchange information with other countries so that there is tax transparency, etc. So that is also one of the objectives of a tax treaty. But then the thing is, how do you really interpret a tax treaty? Well, interpretation, for the purposes of interpretation of tax treaties, there is something called as Vienna Convention on the Law of Treaties. As I mentioned, VCLT is something sometimes also called as, like a treaty of treaties. All the principles which are around the interpretation of tax treaties, they are contained in VCLT. Now, if you look at VCLT, the basic rule of interpretation is provided in Article 31(1) of the VCLT. And, very clearly it says that a treaty shall be interpreted in good faith in accordance with the ordinary meaning to be given to the terms of the treaty in their context and in the light of its objects and purposes. We will be discussing the principles relating to, interpretation in a while, but this is what, VCLT actually, talks about. So what they're really trying to say is that the first step is ordinary meaning of the words of the treaties. But those words must be read in the context of the treaty as a whole. And finally, it will also make sense to interpret the terms of a treaty in light of its purpose, because obviously the contracting states, they're trying to accomplish something by entering into the treaty and agreeing on its terms. So it must also be acknowledged that it is vague, and it does not provide any clear, meaningful guidance about the interpretation of treaties. So how much weight is to be given to the ordinary meaning? That is something that you need to actually see. But VCLT is something which provides the basic rule of interpretation in Article 31(1) itself. Now, when it comes to VCLT, VCLT is something, as I mentioned, it's like the treaty of treaties. So it's not really restricted to a tax treaty, but then it applies to, any treaty between two countries. But then when it comes to, the application of tax treaty in specific in the domestic forum, this is where you have the appellate authorities also, and then the courts also. They are primarily governed by, the laws of respective countries, for interpretation. So if you see in India, even before the insertion of Section 90, subsection 2, the CBDT, they came up with a circular where they basically said that where there is a specific provision in the DTAA, then that particular specific provision will prevail over the general provision which is contained in the Act. And when there is no specific provision in the DTAA, it is like the basic law, that the provisions of the Act that will govern the taxation of such income. So this is where Section 90 of the Income Tax Act, it provides that where the Indian government has entered into a particular DTAA that is going to be applicable to the taxpayer, then the provision of the Act shall apply to the extent it is more beneficial to the taxpayer. So what we do as per Section 90 is that it's going to be the DTAA, whatever is mentioned there, or whatever is mentioned in the domestic law, whichever is more beneficial, to the taxpayer, that will actually operate. So that's basically Section 90 of the Income Tax Act. So basically, what I'm trying to say is that there is VCLT, which is provided for the interpretation of tax treaties. But then the thing is that, there are also some basic principles for interpretation of tax treaties. Just take a minute and read through this, and, I'm going to explain all this. Okay, so these are some of the basic principles for interpretation of, the tax treaties. The first one is, the golden rule, or it is more like the objective interpretation. As I mentioned before, this is something we've discussed before as well. It says that any term or word, it should be interpreted keeping its objective or its ordinary meaning or its literal meaning in mind. So as we discussed here, it is, that you should read it, looking at the ordinary meaning of the words of the tax treaty. And that is what is provided by, the objective interpretation. Then there is something called as subjective interpretation. Subjective interpretation is basically meaning to say that the terms of the treaty are to be interpreted according to the common intention of the contracting parties at the time the treaty was, concluded. So it's basically the intention that you have to look at. The intention must be ascertained from the words which are used in the treaty and the context thereof. So you have to read the words in the context of, the treaty as a whole. So it will make sense because according to the purpose, because obviously when the contracting states got into this particular treaty, they were trying to accomplish something, and that is what is, very, very important. So as far as subjective interpretation is concerned, you could actually look at, the speeches out there when, the Indo-Mauritius Treaty was negotiated. There was a speech out there, and you can look at these particular speeches to understand the common intention of the contracting parties when the treaty was being concluded or when the treaty was, being finalized. Then there is something called as purposive interpretation. Now, the treaty is to be interpreted so as to facilitate the attainment of the aims and objectives of the treaty. This approach is also known as the object and the purpose approach. So there is always, like a purpose to, contracting a treaty. As we discussed, there is always like a need, or there is like a purpose, to these particular treaties. And that is what you have to, keep in, mind. You can also, read through the preamble of a particular, treaty so as to see, the purpose and, the objectives and aims of that particular treaty. Then there is the principle of effectiveness. So what you have to do is that a treaty should be interpreted in a manner to have effect rather than to make it void. You have to look at the treaty, from an effectiveness, purpose. You have to look at the treaty, from a whole to understand, what the treaty is all about. So you have to look at a particular treaty from a holistic standpoint. Then there is principle of contemporary and exposition. A treaty's terms are normally to be interpreted on the basis of their meaning at the time the treaty was concluded. However, this is, not like a universal principle, but you have to look at the meaning at the time that the treaty was concluded. What was the intention there? This is, where you can actually look at, the Azadi Bachao Andolan case. This is where you can actually look at, the Indo-Mauritius, treaty out there. So you have to understand that, when obviously today it is, amended, the treaty got amended, but you have to see what was the intention of, the lawmakers when the treaty was being concluded. Did they want inflow of investments, or what was the purpose that they were trying to achieve using that particular treaty? So when it was being concluded, you have to look at the terms and you have to look at their meaning at the time the treaty was being concluded. Then there is something called as liberal construction. Now, this is a general principle of construction for tax treaties, and they say that they should be liberally construed so as to carry out the the apparent intention of the party. So you just have to, um, um, interpret the tax treaties from a liberal, standpoint. Integrated approach. Now the provision which should be interpreted in no provision should be interpreted in isolation. As we mentioned, the entire treaty should be read as a whole to achieve its purpose and its objectives. And finally, there is something called as reasonableness and consistency. So treaties should be given an interpretation in which the reasonable meaning of the words and phrases is preferred, and in which like a consistent meaning is given to different portions of the instrument. So there is something which is reasonableness, which is associated with these particular terms. And what is important is to have, like a consistent position, which is actually taken with respect to these particular meanings. Now, there are also extrinsic aids to interpretation of a tax treaties. Now, there are obviously, other aids also which are available for interpretation of tax treaties, and these include provisions in parallel, tax treaties. So there could be provisions in parallel tax treaties that could, sorry, also be relied upon. Then there obviously articles, essays, there are reports out there which are available, on different databases, on different platforms that can also be relied upon. Then there is also something called as a protocol to a tax treaty, which can also be, read through. There is obviously, as we discussed, a preamble to the tax treaties, which can provide in the intention of, the tax treaty, which can provide also, the object and purpose of the tax treaty, which can be relied upon. And finally, there is something called as MAP. There is something called as mutual agreement procedure. This is a more like a dispute resolution mechanism which is available for tax treaties. Whenever there is a dispute relating to the interpretation of tax treaties, then recourse could be made to something called as MAP. The MAP is something, is a mechanism where the two contracting states, they actually get together to resolve issues relating to interpretation of tax treaties. MAP is something that we will be discussing in detail in a while, but that is also an extrinsic aid to interpretation of a tax treaty that can be relied upon. So what these are, really like the basic principles, that can be relied upon for interpretation. Now, the thing is that if you pick up a particular tax treaty, let's say that, we actually rely upon the India Mauritius tax treaty, or we rely upon the India UK tax treaty, or we rely upon the India US tax treaty. Now, what is very interesting is that when you look at these particular, tax treaties, it's going to be obvious that Article 5 will always talk about permanent establishment. Article 4 will always talk about, residence. Article 7 will always talk about business profits. So how are they so consistent in, that particular approach? Well, that is because these particular tax treaties, they are developed and they are based on two models out there. And that is, helping them maintain this particular uniformity in the format of these tax treaties. So there are different models which are developed, over a period of time based on which the treaties are drafted. These models, as I mentioned, they help in maintaining uniformity in the format of tax treaties, and they also serve as like a checklist for ensuring exhaustiveness or provisions to the two negotiating countries who are basically negotiating a particular tax treaty. So these are two model tax conventions that are provided here. Some of the popular ones, this is what I've mentioned here: the United Nations Model Taxation Convention between developed and developing countries, and the OECD Model Tax Convention on Income and on Capital. There are other models also. There is also, something called as the US model out there. But yeah, these are the popular ones, the UN and the OECD, model. So let's start with discussing what exactly is, this OECD, model out there. Well, the OECD model was first published in draft form in 1963, and since then there have been revisions to this particular model that actually happens. Um, um, there is also something called a CFA, which is the Committee on Fiscal Affairs. This particular committee, with the working party groups, they have the responsibility for these particular model tax conventions and obviously other matters of international tax cooperation. They have the responsibility, for that. Now, very peculiar feature about the OECD Model Taxation Convention is that it favors capital exporting countries over capital importing countries. What does that mean? Well, it basically means that if there's double taxation, it will require the source country to give up its taxing rights. Um, So the thing is that if it eliminates double taxation, or then it mitigates double taxation by requiring the source country to give up some or all of its tax on certain categories of income, which is earned by residents of the other country. However, um, so this is the reason it's a more favoring capital exporting countries, because it will always require the source country to give up its taxing rights. It will always, it will be the residence country, out there. But then OECD Model Taxation Convention, this is the reason it may not be appropriate so much for net capital importing countries. So this is the reason, if you look at a developing country, they have devised their own model tax treaty, which is basically the UN Model Taxation Convention. So this is the UN Model Taxation Convention. This is where they talk about the UN Model Taxation Convention. Now, the main difference is that it provides greater taxing rights to the source country. Until about 1980, there was no UN model. The Indian tax treaties for periods before this time are closer to the OECD model, and then subsequently, the treaties have been strongly influenced by the UN model, and they have greater emphasis on something called as source-based taxation. And this is the reason we say that, if you look at the UN Model Taxation Convention, it generally favors retention of source country taxing rights, the taxation rights of, the host country of investment, as compared to really the residence country of the investor. Um, this has long been regarded as an issue of special significance to developing countries, although it is like a position that some developed countries also seek in their, bilateral treaties. So if you look at the UN Model Taxation Convention, it sort of represents, like a compromise between the source principle and the residence principle, but it gives more weightage to the source principle than does the OECD Model Taxation Convention. Um, so it's not, wanting to be prescriptive, but then it equips decision makers, to understand the consequences of these different approaches out there. So if you look at India's tax treaties, most of India's tax treaties are based on something called as the UN model. So what I've done is I've just provided in for a difference between the OECD model and the UN model. This is exactly, everything that I spoke about. This is, the difference out here. I'd advise you to just spend 1 minute looking at this particular, difference, and then we'll move on to the specific articles in a model taxation convention. Okay, so this is basically the difference, as I mentioned. All the difference was already mentioned in, these two slides right here. But this is really the difference between the OECD and the UN Model Taxation Convention. What is interesting is that the OECD model advocates residence principle, but the UN model, it gives more weightage to, the source principle. That is, income should be taxed where it actually arises. Now we'll go to some significant articles, in this particular model taxation convention. There is, Article 1, which is basically persons covered. Now, who does the article apply to? Well, if you look at the UN model or the OECD model taxation convention, they would apply to persons who are resident of one or both the contracting state. What I'm really trying to say is that you have to be a resident of a particular contracting state to be able to take advantage of that particular tax treaty. If not, well, there are issues of something called as treaty shopping. But you have to be resident of one or both of the contracting state so as to be able to, take benefit of a particular tax treaty. Now, the income which is derived through, an entity or an arrangement that is treated more like a wholly or partly physical, transparent entity, that shall be considered to be the income of a resident of a contracting state. But then the thing is that it will be considered to be an income only to the extent that the income is treated as the income of resident of that particular state. Now, the second one is Article 2, which talks about taxes covered. Now, they're really trying to say that now that you're a resident and a treaty applies to you, what is the kind of income on which the treaty will apply? Well, the OECD and the UN Convention, they say that the treaty is going to apply on taxes on income and on capital, which is imposed on behalf of a contracting state, irrespective of the manner in which they are levied. So taxes on income and on capital, they cover all taxes which is imposed on total income, on total capital, or on elements of income or capital. It can include taxes on gains, from alienation of movable or immovable property, as in, capital gains, or taxes on total amounts of wages and salaries which are paid, or, capital appreciation, etc. Um, um, so it's going to apply to all these, particular taxes. It's going to be mentioned in the, a particular tax treaty also. And then the existing taxes to which the convention actually applies, they will be specifically, as I mentioned, will be mentioned, there as well. So that's Article 2. Then there is something which is very interesting, which is Article 4 of a particular tax treaty. Now, Article 4 talks about, the definition of resident. It talks about who is a resident of a contracting state. If you see, Article 1 talks about that it's going to be applying to resident. Now, who is a resident of a contracting state? Well, it's going to start with the definition of resident, and then it's going to talk about something called as the tiebreaker rule for an individual and for a company. So let's look at who is a resident for the purposes of, a tax treaty. Now, as I mentioned, Article 4 provides for this particular definition. It's going to be a very exhaustive definition, and it will determine the applicability or the non-applicability of the treaty. Why? Because this is to be read in sync with Article 1, which is persons covered. Sorry, just give me a minute. Okay. So this is, as I mentioned, going to talk about, the definition of resident for the purposes of, the tax treaty. Now, if you look at the UN Model Taxation Convention, the term resident of a contracting state, it means any person who under the laws of that state is liable to tax therein because of, the person's domicile, the person's residence, the person's place of incorporation, place of management, etc. So if resident of a contracting state basically means that you are liable to tax in that particular state. And why are you liable to tax? Well, because, maybe you have domicile there or you have a residence there. If you are a company, maybe you have, a place of incorporation there or a place of management, there. But then this term, it does not include any person who is liable to tax in that state because you have a source of income, from that state. So we're talking about residence-based taxation here rather than, something called as source-based taxation. Now, what if, one country says, let's say for the purposes of a company, one country says that you are a resident of this particular, country because you have been incorporated here. The other country country says that you are a resident of this particular country because you have place of management or place of effective management here. Now, this is where there could be something called as a tiebreaker out there. There could be, like double taxation out here. And this is where a tiebreaker rule for company comes into place. So this is Article 4, sub-article, 3 of the OECD model and the UN model that comes into place. And this article provides for, something called as a tiebreaker rule for, companies or, for body of persons like partnership firms, etc. And it may be resident of both the contracting states, where one country taxes the company basis place of incorporation and the other does basis something called as place of effective management. So under these rules, if a person other than an individual is a resident of both, then this case has to be separately considered by the competent authorities. And then you could make use of something called as MAP, as I mentioned, which is, basically under Article 25. So that is how the tiebreaker rule for companies is. But then the tiebreaker rule for individual is a little more, specific. So what if an individual, because of the residential status rules of two countries, happens to be resident of two countries out there? Because, the domestic law of those particular two countries are such that they become resident in this country and they also become resident in, the other country. For that, there is a tiebreaker rule for individuals as well. The tiebreaker rule says that you're going to be resident, if you are resident of, both the countries, then you will be resident of the country where you have a permanent home. Well, if you have permanent home, in both the countries, well, then you will be resident of country where you have center of vital interests. What is center of vital interest? Where you have more personal and economic relations, where they are more closer. Well, if that's not the case, then where your habitual abode is. Well, if that's not the case, then where you are national of. That will be the concluding tiebreaker, rule. Wherever you have nationality, that is where you will be, resident of. If that also does not help, well, then you will be resident of a place which is going to be solved by mutual agreement between the competent authorities of the contracting states. So you'll have to look at something called as MAP for that particular purpose. So this is basically Article 4. And as I mentioned, Article 4, talks about the definition of resident and talks about, the tiebreaker rule for individuals, and it talks about the tiebreaker rule for companies. Now, the next thing is Article 5 and Article 7 of the Model Taxation Convention. Article 5 talks about a concept which is called as permanent establishment. And then Article 7 talks about the taxation of permanent establishment. Article 7 is actually business profits, but it talks about how permanent establishments will now be, taxed. So let's look at the first one, which is Article 5. Now, Article 5 and Article 5 of the OECD Model Taxation Convention is similar to Article 5 of the UN Model Taxation Convention. There are a few differences that we will be, talking about. But the thing is, what is a permanent establishment? Well, a permanent establishment is more like a taxable presence that an enterprise of one contracting state has in another contracting state. So let's say that there is a company in the resident state. If the company in resident state has some activities in the source state, how will the source state tax that particular activities? Well, the source state can tax those particular activities only to the extent that it becomes a permanent establishment, right here. If it becomes a permanent establishment, then their activities are going to be taxable in, the source state also. So this is the reason we need to find out. The first thing is if there is a permanent establishment or, not. So this is the reason it says that PE, it is a taxable presence that an enterprise of one contracting state has in the other contracting state, which is outside your company's state of residence. The taxability of activities undertaken by a foreign company on foreign soil, it depends on the presence of PE on that particular foreign soil. And the fundamental rationale behind the PE concept is to allow, within certain limits, the taxation of non-resident enterprises in respect of their activities, having regard to assets used and risk assumed in the source jurisdiction. Now, if you look at the kind of PEs that we have, there are quite a few. Now, there is something called as a fixed place permanent establishment. A fixed place permanent establishment is provided here, so we'll discuss it in this particular slide. Then there is something called as a service permanent establishment. You have to remember that the concept of a service permanent establishment is something which is very specific to the UN Model Taxation Convention. It's not there in the OECD Model Taxation Convention. Then there is something called as agency PE, dependent agents and independent agents. There's something called as a construction and installation permanent establishment. All these permanent establishments are something which we will be, discussing going forward. But just take a minute and, just read through these different types of PEs that we have. Okay, so the first one that we have is, Article 5, Sub-Article 1, which basically of the OECD Model Taxation Convention or UN Model Taxation Convention or tax treaties for that matter. It is a fixed place permanent establishment. It says that PE means a fixed place of business through which the business of an enterprise is wholly or partly carried on. Meaning to say that, there are three mandatory requirements for a fixed place permanent establishment to exist. There has to be something called as a place of business. There has to be, like a place of business which is fixed, and there has to be at the disposal test. What they're really trying to say with place of business is that there has to be some business activity that has to be carried on in the source state to call it a permanent establishment. Any business activity has to be, carried on. Then this place of business must be fixed, as in it should be, stuck to a particular geographical location, should be identifiable to a particular specific geographical location. That basically means that the place of business is going to be fixed. And thirdly, they say that there is something called as at the disposal test that has to be satisfied. What is at the disposal test? It basically means there should be effective power for the company to use that particular area in the source state. It should be it should be at the disposal. That particular area in the source state should be at the disposal of the company. They should have effective power to use that particular area in the source state whenever they want. So if these three requirements are satisfied, there's a plus out there, then this is going to be referred to as a permanent establishment in the source state, and the source state will get taxing rights onto the profits from that particular permanent establishment. So this is called as a fixed place permanent establishment. Now, there are, specific inclusions to a permanent establishment, and this is provided in Article 5, Sub-Article 2 of, the Model Taxation Convention. These specific inclusions mean, that there could be, like a place of management, a branch, office, workshop, factory, a mine, uh, uh, you know, uh, oil or gas well, etc. This is, a typo. So there could be a place of management, branch, office, workshop, a mine, place of extraction of natural resources, etc. This is basically, the specific inclusions to the definition of permanent establishment. But then you have to understand that this is not an exhaustive, list. It could go far beyond. It has to be dependent on, different facts and circumstances. Now, the next thing is basically something called as a construction or installation permanent establishment. Now, if there are construction activities carried on in a source state, then this could actually construe to something called as a construction or installation permanent establishment. But it's not as simple as that. The kind of sites and activities included for this purpose include that of installation or construction of buildings, roads, bridges, canals, pipelines, etc. Now, demolition and clearance site fall under this category as well. So it's basically, assembling the movable property that is also, included in this particular thing. So this is installation and construction permanent establishment. Now, the UN Model Taxation Convention says that this site or project or activities are to last for more than 6 months to constitute a PE, whereas OECD Model Taxation Convention says that this period should be more than 12 months. And this is precisely the difference between the OECD and UN Model Taxation Convention. You see how UN Model Taxation Convention gives precedence to source-based taxation right here, more closely as compared to the OECD Model Taxation Convention. So that is a construction or installation permanent establishment. Now, Article 5.4 talks about some specific exclusions from PE. They basically say that PE shall not be deemed to be include, storage, display, delivery of goods, or if there is a place where there is, stock that is being maintained. What they're really trying to say is that if a particular activity is preparatory or auxiliary in character, well, then it's going to be excluded from, permanent establishment. This will not construe something called as a permanent establishment. The next thing is something called as an agency permanent establishment. Now, agency permanent establishments are of two types, something called as a dependent agent, and there is something called as an independent agent. Now, PE will be deemed to be established in cases where, let's say, there is a person who's acting on behalf of an enterprise and they habitually conclude contracts on behalf of the enterprise, or they play like a principal role leading to the conclusion of contracts in the name of the foreign enterprise. Well, then it's going to construe something called as a dependent agent PE. So dependent agent, if there is an agent dependent, well, then it's going to construe something called as a permanent establishment. But then obviously there are also something called as an independent agent. Now, paragraph 5.6 applies to them, and it says that it shall not apply where the person who's acting in a contracting state on behalf of an enterprise of the other contracting state carries on business in the first mentioned state as an independent agent and acts for the enterprise in the ordinary course of that agent, in the ordinary course of that business. So what they're really trying to say is that, if you have an agent which is acting in ordinary course of their business and which is not dependent so much, which is basically an independent agent, well, then it's not going to construe a permanent establishment. So dependent agents, they make permanent establishments. Independent agents, they do not make permanent establishments. The last thing that is there is something which is called as a service permanent establishment. So this is something, as I mentioned, very specific to the UN model, and it'll something which you will not find in the OECD model, is where there are services that are being rendered. If there are services that are being rendered by personnel, including consultancy services, or by employees or other personnel from the residence country to the source country. And if these services are being rendered for more than 183 days in any 12-month period, well, then it's going to construe something called as a service permanent establishment. So as an example, providing consultancy services by the employees or other personnel in the source state can construe a permanent establishment for the resident state. What kind of permanent establishment? Like a service permanent establishment. So these are, as I mentioned, the different types of permanent establishment. And what I've done is this particular chart also talks about, whether this will be a PE or not. It's all provided, right here. This is more like a summary chart out there. So I'd say that you take a minute and, just read through this particular chart. Just revise through this particular chart. Okay. Now, the next article that should be of relevance to us is something called as business profits. Now, business profits is, comes into place, which is Article 7. It comes into place after Article 5 has been satisfied. That basically means that only if there is a permanent establishment now the next step is to determine how much profits of the permanent establishment will be taxed in the source state. So, the profits of the enterprise of a contracting state shall be taxed only in that contracting state, unless obviously there's a permanent establishment, out there. If the enterprise carries on, business, then whatever is the profits which is attributable to the permanent establishment, that will be taxable in, the source state. So these are the key aspects. That there should be a non-resident which is carrying on business in the host country. Then there has to be a permanent establishment. There has to be business which is carried on through the permanent establishment, and there is income which is attributable to that permanent establishment. That income is going to be taxable in the source state. Now, if you look at the OECD model, they follow something called as the AOA approach, authorized OECD approach, which basically means that you have to look into FAR analysis, the functions performed, assets used, and risk assumed analysis, so as to see how much is the income that is attributable to the permanent establishment. However, if you look at the UN model, this is where they use something called as the force of attraction rules. Sir, can you hear me properly? Sir, am I audible properly? Um, okay. So there is something called as, the force of attraction rules, when it comes to, the UN model. The force of attraction rules basically says, let's say that there is a head office, right here, and this is in the residence country. Now, if there is a PE in the source country, well, generally, whatever are the profits of this particular PE source country, they will be taxable in the source country. But then even if there are sales being made directly to customers in the source country, or there are direct sale activities to customers in the source country, that will also be taxed by the source country, even if it is bypassing the PE out there. So what force of attraction rules they really do is to expand the taxing rights of the source country to the business income of an enterprise. This extension to tax profits even from direct sales of similar goods in the source state without the involvement of PE. This is called force of attraction rule, and this is something which is mentioned in the UN Model Tax Convention. So this is what Article 7 of the UN Model Taxation Convention really talks about. Now, the next one is Article 11 of the Model Taxation Convention, or a tax treaty, which is basically interest. Now, how is interest income to be allocated? The right to tax interest income. Well, interest basically means the income from debt claims of every kind, whether or not they're secured by mortgage, or whether or not they're carrying a right to participate in the debtor's profile. That is basically interest. Now, the thing is, if you read through Article 11, paragraph 1, this is where it confers the right onto the resident state to tax interest. But then the thing is that paragraph 2 also can confer the right onto the source state to tax interest. Generally, interest is taxed in the source state at a given rate on gross basis. However, if you see that the beneficial owner of interest is a resident of the other contracting state, then the tax or charge has to be less than a specified percentage of the gross interest. This specified percentage in the OECD Model Taxation Convention, it's 10%, but then UN Model Taxation Convention has left it on to bilateral negotiations to identify this particular percentage. Now, the next thing is, basically, royalties. Now, how is royalty to be taxed? This is Article 12 of, the Model Taxation Convention. Now, before we actually get started onto how is royalty going to be taxed, which what is the right of the contracting state to tax royalty, the first thing is to understand the definition of royalty, because the definition of royalty is something which is different in the UN Model Taxation Convention and it's different in the OECD Model Taxation Convention. If you read through the UN Model Taxation Convention, it's a very wide, because they say that it means payment of any kind which is received as consideration for use of or right to use copyright, literally artistic scientific work, cinematographic films, or tapes which are used for radio or television broadcasting, patent, trademark, design, model, plan, secret formula, processes, or the right to use industrial, commercial, scientific equipment, or industrial, commercial, or scientific experience, etc. Now, the definition is very, very wide as the UN model taxation is concerned. But the definition of royalties under the OECD model, it does not include rental for films or tapes, which are used for radio or television broadcasting, and even equipment rentals, that is also not included. Now, when you talk about taxing, royalties, the OECD Model Taxation Convention, it says the royalties which are arising in source state, but they're beneficially owned by the resident state, is taxable only in the resident state. So what they've actually done, OECD model, as we also discussed, it gives precedence to resident state to tax. They have given resident state the exclusive right to tax royalty income. But then when you look at the UN model, because it's more focused to developing nations, they have also given and stated that the royalty may be taxed in the source state also. But then if it is beneficially owned in the residence state, then the tax which is charged in the source state has to be less than the specified percentage. And this is to be established through this is to be established through bilateral negotiations for gross royalties. Now, when we talk about the next one, which is Article 12A, which is fee for technical, services. So I think just allow me a minute here. We'll take a short, 5-minute break here to, I think I just need to fix my laptop. It's not charging. So just allow me 5 minutes. Sir, we can take a 5 minute. Hmm. Is fee for technical service. Now, the UN model, it basically has a specific article, uh, pertaining to fee for technical services. Now, this is where you have to remember that there is no reference to FTS in the OECD, model. So there is paragraph 1 of Article 12A, and this provides that there is something called as FTS. It may be taxed in the resident state, but does not provide that FTS is exclusively taxable in the resident state. So you have to remember that FTS is taxable in the residence state. What is FTS? FTS is basically payment for fee for technical service. It basically means fees, payment for managerial, technical, consultancy services. Now, what is management, services? It involves the application of knowledge, skill, expertise in the control or administration of the conduct of a particular commercial enterprise or organization. Technical, that involves the application of specialized knowledge, skills, or expertise with respect to particular art, science, profession, or occupation. And the ordinary meaning of consultancy, that involves the provision of advice or services of a specialized nature. Now, that is basically FTS, fee for technical services, management, technical, and consultancy services. Now, you have to remember that there are certain services that are excluded from FTS. It is going to be payment to an employee, or payment for teaching in an educational institution, or teaching by an educational institution, payment made by individual for services for personal use. That is excluded for, FTS. So let's try to understand this particular example of FTS. Now, there is our company, which is a financial institution. It is resident in state R. Our company, it provides a wide variety of financial services to its customers: acceptance of deposit, credit, guarantees, foreign exchange, negotiable instruments, etc. Our company's business is conducted primarily in state R, but then they also have clients in another, country like state S. Now, state R, state S, they have a treaty and they have Article 12A FTS in that particular treaty. Now, the payment which is received for services which is provided by a financial institution, it would constitute FTS only if there is, some knowledge, skill, expertise, etc. in that particular, sense. This has to be distinguished from non-specialized services, like payment of service, payment, transmission services, debit credit services, etc. They do not involve any specialized knowledge, skills, etc. So that is not to be included right here. Then there is Article 12B, which is income from automated digital services. Um, Now, Article 12B was added to the UN Model Taxation Convention in 2021 update, just to make sure that, if there is a domestic tax, uh, domestic law taxing rights for states, for which payments for automated digital services are made. But there is no article in the OECD Model Taxation Convention that corresponds to Article, 12B. Now, what is automated digital services? These are services which is provided on the internet or another electronic, network, which requires minimal human intervention or minimal human involvement from the service provider. So these are expressly automated digital services. Online advertisement services, supply of user data, online search engines, social media platforms, online gaming, etc. These are specifically known as, automated digital services. Now, there is also, what happens to the taxing rights when it comes to income from automated digital services. Well, there is Article 12B, Para 1, which basically confers the right to the resident state to tax income from automated digital services arising in a contracting state. But it does not state that FTS is exclusively taxable in the, resident state. And paragraph 2, it establishes the right of the source state to tax income from automated digital services according to the domestic law, subject to specified percentage of gross amount of payments. The next thing is Article 13, which basically talks about capital gains. Now, this article does not specify what is a capital gain and how it is to be computed, but then this is left to the applicable, domestic law to understand how is capital gains, to be taxed. Now, the right to tax capital gains may be exclusively with the resident state, or it may be shared between the resident state and the source, state. This is going to include everything, like from gains which are arising from alienation of different property assets, movable assets, immovable assets, PEs, shift aircrafts, etc. Now, for shares, because that is also like a capital asset, OECD and the UN Model Taxation Convention is identical. Now, it basically says that they confer the right to tax onto the source state if more than 50% of the value of the shares are derived from the immovable property which is in the source state. Otherwise, it's going to be the resident state, which is going to be taxing this particular capital gain. Article 14, they talk about independent, personal services. Now, this particular article, which is present only in the UN Model Taxation Convention, it actually deals with taxation of income, which is derived by a person from professional or specified services, and they're offered in the source state through some presence. Now, for this particular article, we have to define obviously what is professional service. Professional service is something which includes, independent scientific, literary, artistic, educational, or teaching activities, as well as independent activities of, physicians, lawyers, engineers, architects, accountants, dentists, etc. Um, you have to remember that OECD Model Taxation Convention, it does not include like a separate article on independent personal services. They actually look at business profits, which is Article 7, and that is, taking care of this. But then in the UN model, we have like a specific article, Article 14, for independent personal services. The next article is very interesting, which is Article 23A and 23B. Now, this particular article talks about, elimination of double taxation. How is double taxation to be eliminated? For this purpose, they have two methods available out there. There is Article 23A, which talks about a method which is called as the exemption method, and there is Article 23B, which talks about a method which is called as the credit method. Um, um, now, Article 23A and Article 23B, they provide for mechanism through which tax credit or exemption may be available in the resident state for taxes which are deducted in the source state. Now, when you look at something called as an exemption method, tax exemption method basically means one nation will completely exempt the income out there. It may be available in, let's say, the resident state for taxes which are deducted in, the source state. And then there is also something called as, the credit method. Credit method basically is provided in Article 23B, and it says that there could be a tax credit which could be available. So, the taxes that have been deducted in the source state, the taxes that you've paid in the source state, they might be available for, credit in the resident state whenever residents, returns are being filed. So that's exemption method and the credit method. Then there is something called as Article, 25, which is mutual agreement procedure. Now, as I mentioned, this is the dispute resolution mechanism, which is available. This is like an alternate tax dispute resolution mechanism, which is available to taxpayers under the double taxation avoidance agreements or like a tax treaty. This is Article 25, and they basically say that whenever you have dispute which is giving rise to double taxation or taxation which is not in accordance with the DTAA, then you can have MAP available. MAP will help to resolve double taxation either fully or partially. On almost all the tax treaties around, they have MAP available. It's available in the Indian treaties also. There is something called as MAP, which is available. So this is more like a dispute resolution mechanism, which is in addition to the domestic law of India. And whatever are the remedies which are provided in Indian domestic law, you can take or seek help of MAP, irrespective of that, regardless of whatever are the remedies available in the domestic law. So what happens in MAP is that it enables the competent authorities of India to engage from an Indian perspective. It helps or enables the competent authorities of India to engage with the competent authorities of treaty partners of another, nation, and then they get into discussions and negotiations between both treaty partners, and they resolve, or they intend, or they endeavor to resolve international tax disputes, which is not in accordance with the tax treaties. So there could be issues relating to transfer pricing adjustments, or existence of PE, attribution of profits to PE, or characterization, royalties, FTS, all these kind of issues can actually go into something called as MAP. The next article that we have is Article 26, and Article 26 talks about something called as exchange of information. Now, as I mentioned before, I think we've talked about this particular article, at length, but this is, the article that helps in exchanging information, with the other nation. Why is exchange of information important? Well, importance of Article 26 is provided because it facilitates effective exchange of information between different contracting, states, so that there is something called as tax transparency, which is available. How will tax transparency help? Well, tax transparency will help in curtailing cross-border tax evasion and avoidance. So there's not going to be tax evasion and avoidance if the countries know what is the kind of income that is parked in their nation, etc. So that is basically Article 26 of a tax treaty. With this, I think we finish with, the tax treaty, and what we have next is something called as BEPS. Now, I think I've explained, how there was base erosion and profit shifting that was happening. Also, when we were discussing transfer pricing, in the last lecture, we did discuss, issues of we discussed issues of tax avoidance. Now, there was something that was to be done so as to make sure that this profit shifting from high tax jurisdiction to low tax jurisdiction does not happen, how base is not eroded using deductible payments, etc. So there was something that was to be done, and this is the reason the OECD nations and the G20 nations got together, and they came up with a framework which is called as the OECD G20 inclusive framework on base erosion and profit shifting. They came up with something called as BEPS. And what is BEPS? Well, BEPS was basically tax planning strategies, and they were exploiting gaps and mismatches and shifting profits from from high tax jurisdiction to low tax jurisdiction, etc., with those deductible payments like interest and royalties. And this is the reason the OECD and the G20 countries, they got together because they said that we'll address these particular weaknesses in international tax system. So what they did was they came up with these 15 action plans. They came up with these 15 areas where they thought that tax avoidance strategies, was in place. And this is the reason they came up to develop rules so as to make sure that these tax avoidance situations do not happen. And profits are taxed where economic activities generating those profits are performed, and then where value is, actually created. So when they came up with BEPS, uh, there were these 15 action plans, under, sorry, there were these 15 action plans under, BEPS that we'll be, just talking about these 15 action plans, under BEPS. But there were these three key objectives of the BEPS project. One, they wanted to introduce coherence in domestic tax laws that affect cross-border activities. So there should be some level of coherence between the different domestic, rules that you have. There should be something called as substance requirement, more like substance over form, kind of requirements in international standards. And finally, they wanted to improve transparency as well as certainty. So there should be tax certainty, there should be tax transparency, etc. So this is the reason they devised like a list of 15 action plans out there under these three objectives. So if you see, the first action plan is addressing the tax challenges of the digital economy. How, the digital economy is actually expanding, and the traditional economy is no longer satisfying. The international tax rules are not satisfying the traditional economy, and the digital economy is actually expanding. So this is the one which will address the tax challenges of the digital economy. Then neutralize the effect of hybrid mismatch was action plan 2. Then to come up with CFC rules and to strengthen the CFC rules, there was action plan 3. Then action plan 4 was to limit interest deduction. This is something which we discussed yesterday at length, section 94B, which has been introduced in the Indian Income Tax Act. Then counter harmful tax practices was action plan 5. Then prevent treaty abuse was 6. Preventing the artificial avoidance of permanent establishment status was 7. Then ensuring transfer pricing outcomes in line with value creation. This is where they talk about DEMPE analysis. This is action plan 8 to 10. Then action plan 11 was collect and analyze BEPS data and take actions to address it. 12 is disclose aggressive tax planning arrangements. 13 is re-examining transfer pricing documentation. This is again something that we discussed yesterday, which was, where they've come up with the three-tier documentation structure, like a local file, a master file, and a CBCR. And then finally, 14 was dispute resolution mechanism, improving that. And finally, 15 was to develop a multilateral instrument, MLI. So these are the 15 action plans that have been, devised, by the OECD and with, the G20 nations put together. So this is, BIPS Action Plan 1, which talks about addressing the tax challenges of, the digital economy. So just take a minute and, just read through this chart and I'll explain it in a while. Take 1 minute and read through this chart. Okay, so this is, as I mentioned, OECD BEPS Action Plan 1, which is on addressing the tax challenges of, the digital economy. Now, this is where what they were actually trying to do is they saw that the digital economy was actually expanding. And when they looked at, the international tax rules, they were incompetent enough to actually tax the traditional economy. So what they did was to, make sure and come up with rules to address the challenges of the digital economy, to tax the digital economy basically. And this is where we have a two pillar solution right here, which is called as pillar one and pillar two. This is something that we will be discussing at length in the next chapter, which is latest developments in international tax law. This is what we will be discussing. But then, for the purposes of addressing the tax challenges of digital economy, for the purposes of Action Plan One, they came up with some recommendations. They said that you should modify the existing permanent establishment rule to provide that whenever they have like a digital activity, that can also constitute a permanent establishment in the source state. And then they said that a virtual fixed place permanent establishment, when the enterprise maybe maintains like a website or on a server in another jurisdiction through which the business is actually being carried on through that particular website. So that is what was recommended by the OECD. Now, this is where they made appropriate provisions in the Indian Income Tax Act. They made an amendment to Section 9 of the Income Tax Act, and they came up with something called as SEP, Significant Economic Presence. What is SEP? Well, significant economic presence basically will constitute like a business connection in India. If you're connecting with users in India, or if you're, somehow connecting or making revenue, in India through digital means, very, very casually put, well, then it's going to constitute a business connection in India. And whatever is the profit being derived from that particular business connection, that should also be taxable in India. Now, they came up with specific rules for that, and they said that if you have services in respect of download of data or software in India, well, then if you have payments arising from that, which is more than 2 crore rupees, then it's going to constitute significant economic presence in India. Or, if you are engaging with users in India and the number of users are, at least 3 lakh, well, then also it's going to constitute as significant economic presence, in India. So that is SEP that they actually, came up with. After that, they also came up with section, 194O, where they actually provide for withholding tax, out there. And they basically said that if you are, providing services through an e-commerce participant, then you're liable to deduct TDS on the gross amount of such sales or, services. So that is basically OECD BEPS Action Plan 1. And we will be discussing this in a lot of detail, going forward. After that, they came up with OECD BEPS Action Plan 6. Now, BEPS Action Plan 6 talks about preventing treaty abuse. This was the OECD minimum standard, and they basically said that, looking at, the risk that is to revenues posed by there's something called as treaty shopping. So the countries have committed to ensuring like a minimum level of protection against treaty shopping. How are they protecting the treaties? Well, they said that you can introduce something called as a limitation of benefit clause in your treaties, or you can have, something called as a principal purpose test, or, there could be like a combined approach of LOB and PPT, or you could have like a PPT, alone, or you could have the LOB clause, which is the limitation of benefit clause, which is supplemented by a mechanism that will deal with, conduit financing arrangements, which not already dealt with in, tax treaties. So what is the limitation of benefit clause? Well, they say that the benefits will be limited to certain extent. We'll talk about this from, the Indian Mauritius standpoint. And then they said that you can introduce something called as the PPT. PPT is a rule that, if the principal purpose is, claiming, tax benefits, then it's going to be disallowed. Well, the LOB clause is something that they incorporated in the tax treaty, especially in the India-Mauritius tax treaties. It was, in 2016 that the Indo-Mauritius tax treaty was amended for the first time. And they basically, for capital gains, the rule was initially residence-based taxation. But now they say that the capital gains are going to be taxed in India. But the LOB clause they provided in that particular tax treaty, and it basically said that the resident of a contracting state shall not be entitled to benefit of 50% of tax rate, which was, the transition period, if the affairs are arranged for the primary purpose of taking benefit of the concessional tax rate. So this is what, they, provided in the Indo-Mauritius tax treaty when it comes to the LOB clause. So what they're really trying to say is that, the benefit are going to be limited or restricted in case of that particular treaty if they find out that the primary purpose was to take benefits of, like a tax benefit which is provided in that particular treaty. The primary purpose is that, well, then they'll be, limited or they'll be curtailed, so to say. So that is Action Plan 6. Then there is BEPS Action Plan 7. BEPS Action Plan 7 talks about preventing the artificial avoidance of, PE status. Now, this is where OECD recommended that, listen, you should review the definition of permanent establishment. Now, why should you review the definition of permanent establishment? Well, that is because there was a lot of tax avoidance that was happening because of looking at, that particular definition of permanent establishment. So what they did was they said that, you should introduce something called as commissioner arrangement. You should modify Article 5.5 to include that, a person who habitually plays a principal role leading to conclusion of contracts in the definition of agents. Remember, we were discussing Article 5.5, which talked about agency permanent establishment. So that is where they said that you should include this particular thing. And then they said that by way of fragmentation of business activities, so you should include something called as an anti-fragmentation rule to prevent fragmentation of functions, which otherwise a whole activity to avail benefit of exemption. Now, what was happening here was that they basically said that um, if a particular activity is preparatory or auxiliary, then it's not going to constitute a permanent establishment. I think this is what we also read as specific exclusion, the exclusions from permanent establishment definition. Now, what MNCs started to do, just as a casual example, they started to fragment their activities. One small thing that they said is preparatory and auxiliary, so excluded. One small thing, this is also preparatory and auxiliary, so this is excluded from, PE. But if you look at these activities from a holistic standpoint, from a whole standpoint, then this was the entire business. So this should not be excluded. So this is the reason they came up with like an anti-fragmentation rule to prevent fragmentation of functions, which on a, like a separate level, maybe preparatory or auxiliary. But when you look at it on a whole basis, then this is the actual activity. So, this is the recommendation that they provided. Now, this is the reason there was a provision incorporated in Income Tax Act 1961 for business connection. And they said that business connection includes any business activity which is carried through a person who, on acting on behalf of the non-resident, habitually concludes contracts or habitually plays the principal role leading to conclusion of contracts by the non-resident. So, but these contracts should be in the name of the non-resident for transfer of ownership for provision of services by that particular non-resident. So they made these provisions, they were incorporated in the Income Tax Act of 1961. So just take a minute and read through, this particular slide on Action Plan 7, preventing the artificial avoidance of PE status. Okay, so the next action plan that we have is Action Plan 13, which is re-examining transfer pricing documentation. Now, this is something that we discussed yesterday also, but just to give you, like a recap very quickly, OECD came up with a minimum standard of Action Plan 13, where they introduced a standardized approach to transfer pricing documentation. They said that there should be like a three-tier documentation structure that should be, provided. And this should consist of something called as a local file, a master file, and a country by country report. Now, as far as the local file is concerned, they said that this is going to include transactional information, which is specific to each country, and it should cover all related party transactions. Now, this is to be delivered, or this is to be filed, to the local tax administration. Then they said that you should introduce something called as a master file, like a standardized information, which is relevant for all the multinational groups, which basically talks about global business policies, global business operations, transfer pricing policies on a more holistic, level for the group as a whole. Then they introduced something called as, like a CBC report. Now, this is going to have information relating to global allocation of the multinational company's income and taxes paid. And it's going to provide an indicator of, the location of the economic activity within the multinational group. Now, while master file is to be filed, by the local to the local tax administration, CBC report is something which is to be filed in the tax residence jurisdiction of the ultimate parent entity of the UPE. Now, are the provisions introduced? Yes, these particular provisions were incorporated in the Income Tax Act of 1961. So, Section 92D has been incorporated, where they have provided, the requirements for maintaining and furnishing of, master file. And then, as we discussed yesterday, they have provided Section 286, which talks about the CBC reporting requirements and related matters. So Section 286 is something which requires aggregate information with respect to the amount of revenue, the P&L before income tax, the amount of income tax that has been paid and accrued, stated capital, the number of employees, the nature and details of main business activity of each constituent entity, etc. So this is what they have incorporated in BEPS Action Plan 13. Now, the next action plan that we have is Action Plan 15, where they say that you should develop something called as, a multilateral instrument. Now, what is a multilateral instrument? Well, what MLI does is to actually help us fight BEPS by implementing tax treaty related measures which have been developed through BEPS in existing bilateral tax treaties in a synchronized and efficient manner. So, in simple words, what it basically does is to, there is a tax treaty. You want to make changes to the tax treaty, and there are zillion of tax treaties around the world. Now, if you start to make or negotiate tax treaties again with respect to BEPS changes, because to incorporate, BEPS changes, it's going to take hundreds of years. So to make the process easy and less time consuming, they've come up with something called as a multilateral instrument. Now, multilateral instrument is like a standardized document, and it's going to be read in sync with, it's going to operate in sync with, the tax treaties. And on a more holistic level, on a more, casual level, it's going to contain the changes which have been brought in, by BEPS. So it's going to not replace the tax treaties. It's going to be read in conjunction with the tax treaties, bilateral tax treaties, to make it more synchronized and, more efficient. So what multilateral instruments will really do is to actually prevent treaty abuse. They will improve dispute resolution. They will improve they will prevent the artificial avoidance of PE status, and they will neutralize the effect of hybrid mismatches. So this is the MLI. This is like a flexible document. They will modify the tax treaties that are called as CTAs, covered tax agreement. Now, what is a CTA? It's basically like an agreement for avoidance of double taxation that is in force between parties to the MLI, and for which both the parties have a notification that they wish to modify the agreement using the MLI. So that is basically like a covered tax agreement. Has India agreed to MLI? Well, yes. The India basically ratified this particular convention, this multilateral convention to prevent tax treaty related measures to prevent BEPS. That is what MLI is. It was signed by India at Paris on 7th June 2017. They ratified also the said convention, and they've deposited the instrument of ratification along with the list of covered tax agreement, the reservation, the notification, to the depository on 25th June 2019. Now, the date of entry into force of this particular convention for India is 1st October 2019. Um, and this is the first day of the month following the expiry of the period of 3 calendar months, beginning 25th June 2019, which was the date of deposit by India of the instrument of ratification. So, um, the earliest day when this convention can take place is 1st April 2020, which is 6 months from the date of entry into force for India. So it is already, there. So this is basically, MLI. So what we've done is, this was basically BEPS. These were the key objectives of, the BEPS report. So, what we've done is we've looked at action plan 1, we've looked at action plan 6, 7, 13, 15, etc. to see where these action plans, what they do, how are they taken into effect, etc. So that is, the action plans. Now, one action plan that we will be concentrating upon today is basically action plan 1, which is the latest development also in international tax, which is addressing the tax challenges of the digital economy. But before that, let's take a 10-minute break, and we'll come back and discuss action plan 1. So 10-minute break starts now. And we were discussing all the action plans of the OECD BEPS action plan. Uh, this is, as I mentioned, one of the action plans that we will be discussing in detail, which is action plan 1. I will be taking you through the chapter on latest developments in international taxation to discuss what were the latest developments as far as action plan 1 is concerned. So it was actually, in July of 2021 that, 134 members of the inclusive framework, and they represent about 90% of the worldwide GDP. They said that, to address the tax challenges of the digital economy, we will come up with something called as a two-pillar solution. All the efforts that were actually taken to address the digital economy did not come true. And this is the reason they came up with a two-pillar solution to introduce, global minimum tax and on the profits of these large multinational companies. This is the reason they came up with. This is also called as, we call it BEPS 2.0, which is the two-pillar solution to tax the digital economy. So this is pillar one, and then there is pillar two. This is going to run, simultaneously to tax the digital economy. Now, this is, where there is pillar one, and pillar one calls for something called as a new taxing right. It considered the development of new taxing right, and they will change the existing profit allocation and nexus rules. They said that we will try to readjust the balance between jurisdictions where valuable intangibles are owned and the markets where users and consumers are based. So basically giving precedence to market jurisdictions. And then there is, to address, remaining BEPS issues, to address, the digital economy, they came up with something called as Pillar 2. Pillar 2, they basically considered something called as GLOBE rules, Global Anti-Base Erosion Proposal, and this will allow jurisdictions to tax back in circumstances where other jurisdictions have not exercised their primary right, or payments which have been subject to low levels of taxation. This work intersected with the work to develop a new taxing right under pillar 1, and they attempted to define an effective minimum tax rate. So what I'll do is I'll just quickly display the chapter. um, I'll quickly display the chapter to see what the latest development chapter really talks about. So if you can see, this is chapter 8 on on latest developments in international taxation. This is where, the chapter starts with defining something called as BEPS. This is something that we've already discussed, and these were, the action plans that we were talking about. Action plan 1, action plan 2, and so on till action plan 15. Now, action plan 1 is addressing the tax challenges of the digital economy that we will be, taking up, in detail. So this is where they talk about the introduction of a two pillar solution, BEPS 2.0, and looking at the outcome of the work which was carried out in the BEPS action plan 1. This was the top priority of the OECD G20, inclusive framework. So this is the reason there are two, solutions, which is pillar 1 and, pillar 2. Now, if you talk about, this is what we've just discussed. Now, if you talk about pillar 1, as I mentioned, was there to make sure that there is fairer distribution of, taxing rights among jurisdictions. So what Pillar 1 will really do is to reallocate taxing rights over a portion of residual profits of the multinational companies to market countries, and jurisdictions. What are market jurisdictions? Well, where, the users and consumers are basically located, where they have business activities, irrespective of the fact whether they have physical presence there or not. So the thing is that there are two parts to pillar 1. There is something called as amount A, and then there is something called as amount B. So under pillar 1, a multinational company, it is treated like a consolidated entity, and taxing rights, they are allocated on some predetermined formula and assumptions, which we will be talking about. So this is amount A, and then there is amount B. Now, on a more holistic level, if you see amount A is basically like a formula-based return of deemed residual profits, which is going to go to the market jurisdiction. And amount B is an arm's length or fixed return for baseline marketing and distribution, functions. So then there is, as I mentioned, there is pillar one, which basically talks about, or it basically modifies the nexus and profit allocation, rules, and it sort of redistributes profits to market jurisdiction of the multinational companies. They basically say that, it is market distribution, which is helping multinational companies, achieve those particular profits, and there should be allocation of profits to these particular market jurisdiction. This allocated profit, this is termed as amount A. So now market jurisdictions, they should actually fulfill something called as a nexus test to have amount A, allocation. And then there is amount B. Now, amount B is also a very critical component of, pillar one. Amount B, it just simplifies the existing transfer pricing rules for all, taxpayers. It basically is focused on the application of transfer pricing rules or transfer pricing, framework to something called as baseline marketing and distribution activities. Amount B is intended to increase, tax certainty, reduce compliance and administrative, costs. Now, if you look at, the inclusive framework on BEPS, it is nearing the completion of negotiation on final package of Pillar 1. And broadly, the material that has been, introduced by OECD as far as amount A and amount B is concerned is this particular thing that we will discuss. Now, we'll start with discussing amount A first. Now, if there are in-scope companies, with a global turnover of 20 billion euros and profitability, which is above 10%, which is profit before, tax or revenue. So global turnover, 20 billion euros and profitability above 10%. These are in-scope, companies as far as amount A is concerned. Now, after they qualify, amount A is 25% of the residual profit, defined as profit in excess of 10% of revenue that will be allocated to market jurisdiction with nexus using revenue-based allocation key. So what if you look at this particular thing, if you look at the total profit of the M&E group, the routine profits are going to be, the 10% of profit before tax or turnover. After that, the residual profit or the remaining residual profit, it's going to be, the residual profit, 25% is going to be allocated to market jurisdiction. That is going to be amount A. And then there will be remaining residual profits right here. So this is basically amount A. Now, amount A allocation is based on two formulas, two factors. One is something called as a nexus test, and then there is something called as a revenue sourcing rules. The nexus rules applies to determine whether a jurisdiction qualifies for profit reallocation under amount A. So amount A is basically, just meaning to say that amount A is allocated to the market jurisdiction only if there is a nexus that it actually exists. So to make sure now to make sure now that nexus exists or not, we have to apply something called as the revenue sourcing rules. And that will actually identify the jurisdiction in which revenue arises for amount A purposes. Now, to establish nexus, the market revenue threshold is greater than or equal to 1 million euros for jurisdiction with annual GDP of greater than 40 billion euros, or greater than or equal to 250,000 euros for jurisdiction with annual GDP less than 40 billion euros. Now, what are these revenue sourcing rules? Now, it basically means to say that revenue will be sourced to the end market jurisdiction where goods or services are used or consumed. And to facilitate the application of this particular principle, detailed source rules for specific categories, will be developed. Now, in applying these particular rules, they will use like a reliable method, and it's going to be based on particular multinational companies, facts and circumstances. So this is the process to be applied or to be followed for applying the nexus test and the revenue sourcing rules. So first, you have to determine the revenue category. Then you have to identify various transactions in each category. Then you have to use, like a revenue based allocation key. You have to apply sourcing rules to identify the market for revenue in each category. And this has to be done like on a transaction by transaction basis. And in the absence of, specific allocation key, you have to use appropriate allocation keys to source revenue to market jurisdictions. So if you look at amount A, it's more about, market jurisdictions, 25%. Now, amount B. Now, amount B, for that, the Inclusive Framework actually released a report on 19th February 2024, and it was actually aimed at streamlining and, simplifying the application of arm's length principle to baseline marketing and distribution, activities. Now, this is the summary for amount B. The first thing was transactions in scope. You have to understand what are these qualifying transactions within the scope, and consequently the characteristics of in-scope distributors. They say basically, they say that in-scope distributors should not own unique and valuable intangibles, nor should they consume certain economically significant risks. Second is, like a three-step process that determines return on sales for in-scope distributors. And this is going to approximate arm's length, result. Then there are going to be something called as implementation. Now, the report allows jurisdictions the option to apply the simplified and the streamlined approach. This is not going to be binding on the counterparty jurisdiction, but then the report says that they have taken reasonable steps to eliminate double taxation, and but there has to be for that particular purpose like a bilateral treaty in place. And finally, there are additional considerations. So the remaining section of the report is going to deal with, transitional issues, and they're going to be talking about documentation, tax certainty, elimination of double taxation, etc. So that is basically the essence of something called as amount B. Now, after amount B, the second step after, you know that there is something called as pillar one. Within pillar one, there is something called as amount A, and then there is something called as amount B. After these two things, there is something called as a pillar two. Now, what is pillar two? Pillar two just talks about, like having a system to ensure that there is like a minimum level of tax. Now, this pillar is sort of addressing the remaining, tax issues which are identified by OECD G20 BEPS initiative by providing countries with new tools to protect their tax base from profit shifting to jurisdictions that tax these profits below the minimum, rate. So pillar two, it consists of two things. It consists of, as I mentioned, global anti-base erosion rules, and then it consists of something like a treaty-based, rule, which is called as the subject to tax rule. Now, if you look at the globe rules basically introduce like a minimum 15% global tax. They've introduced like a 15% global minimum tax, and it applies to M&E groups with consolidated revenue, of at least 750 million users. They consist of like a coordinated, system of rules under common framework, and it ensures that in scope M&E groups with, consolidated revenue of at least euro 750 million, they pay at least like the agreed minimum level of tax on the income arising in each of the jurisdiction in which they operate. So the minimum level of tax, it may be imposed locally under a qualified domestic minimum top-up tax. And this particular implementation will, has begun, sort of globally. Now, this is basically the globe rules, the minimum tax. And then there is something called as STTR, which is, the subject to tax rules. It takes priority over the globe rules. Now, this is a treaty-based rule, and this is going to allow jurisdictions to impose like a limited additional tax on certain cross-border, payments, where the recipient is subject to a nominal corporate income tax below 9%. So if you have corporate income tax, very nominal, which is below 9%, there could be STTR right there. So what they have actually done, if you look at, a rule like STTR, this has been developed to cater to the priorities of developing nations because, and it's an important part to achieving the consensus of the two pillar, solution, especially pillar two. How do they implement, this particular STTR? Well, they can, sign the MLI, as we mentioned, or they can bilaterally, amend the tax treaties to include STTR when requested by developing the inclusive framework, members. So they can do anything that ways, these two things. This is something that we've already discussed, that pillar 2, it consists of globe rules and STTR, and they STTR, it works in prior to the globe rules. The model rules stipulate an order for applicability of the same, which is this particular applicability. The subject to tax rule, we'll talk about QDMT, IIR, and then there's something called as UTPR. So let's look at the STTR, which is the treaty-based rule, as I mentioned before. Now, the STTR is based on the understanding that where under a tax treaty, a source state, they have ceded taxing rights on certain intra-group payments, then it should be able to recover some of those taxing rights under the income in question in the state of the payee at a rate below 9%. Now, the objective is to make sure that base erosion, especially in developing nations, it does not happen. And this is to define, to have a gross income per capita calculated using the World Bank Atlas method of US dollar 12,535 or less in 2019. Now, coming to, STTR, it's going to be applicable only to covered payments. It will apply only if the sum of covered income, which is arising in the source country, it exceeds a threshold of 250,000 euros or 1 million euro per year. It depends on the GDP of the source country, if it is above 40 billion euros or not. And if you look at covered payments, it's going to be, interest, royalties, distribution rights for a product, or, insurance, reinsurance payments, etc., rental payments, or, guarantee financing fees, etc. So that is STTR. Now, let's take an example right here to understand what is this STTR. Let's say that there is a company A in country A, which is a developing country, and they have entered into a royalty agreement with country B, with company in country B, and this company is called as company B. Accordingly, obviously, country A shall be, this is going to be the source jurisdiction, and this is going to be the resident jurisdiction. The royalty is going to be payable by company A to company B. Now, let's say that country A and B, they have entered into a DTAA, and the source jurisdiction, which is, this one, they basically retain withholding rights at the rate of 5% on royalty payments. And if you look at country B, which is, the resident state, country B royalty payments are taxable at 1%. Now, in this particular situation, if the payer jurisdiction, which is country A, they can impose a withholding tax of 5% on payment of covered income. Covered income is royalty in this particular situation, and the recipient is subject to 1% nominal tax rate. The payer jurisdiction retains 5% withholding tax. Now, if STTR comes into place here, the payer jurisdiction can impose an additional 3% tax on covered income amount. How 3%? Because it is 9%, 5% is already there, 1% is already the nominal tax rate. So what is left is 3%. 9 minus 5 minus 1 becomes 3%. So they can impose under STTR an additional tax equal to 3% of the royalty payment. Now that was STTR. As I mentioned, and now there are globe rules. I think I've mentioned this before. Globe rules apply to constituent entities which are members of the M&E group, and they have an annual revenue of 750 million or more in consolidated financial statements of the ultimate parent entity in at least 2 out of 4 fiscal years immediately preceding the tested fiscal year. So that is what is provided for globe rules. Now, pillar 2, it consists of these particular following rules right here. Now, together with globe rules, they also have something called as um, um, qualified domestic minimum top-up tax. This is also one of these things, that they have. Now, what is QDMTT? Well, this is more like a jurisdictional top-up tax on the constituent entity if it is located in a low tax jurisdiction. Now, there is top-up tax which is computed in accordance with the globe rules out here. Then there is something called as IIR, which is the income inclusion, rule. It imposes like a top-up tax on a parent entity in respect of the constituent entity, which is located in a low tax, jurisdiction. And then there is underpayment tax rule, under taxed payments rule, which is the UTPR. UTPR is triggered where there is, like a UPE jurisdiction and they do not implement IIR or they do not adopt, the globe rules. Then UTPR, it serves like a backstop to IEIR, which is the income inclusion rule. The UTPR, they basically transfer the levy of top-up tax to other constituent entities of the multinational group, which is located in jurisdiction where the globe rules are implemented. So let's take this particular example to understand all these technical concepts on IIR, UTPR, etc., and QDMTT. Let's say that this is, the UPE, the ultimate parent entity. It is located in country X, and they have 3 wholly owned subsidiary in country A, B, and C. Now, let's say that country C is like a low tax, jurisdiction. Uh, the priority ranking as per the model globe rules prescribes that priority 1 is going to be country C, and they will impose QDMTT in its jurisdiction. The jurisdictional top-up tax shall be imposed on wholly owned subsidiary 3. Priority 2 will be where country C does not impose QDMTT in its jurisdiction, then the UPE of the multinational group in country X, which has implemented IIR under globe rules, shall be liable to pay tax in an amount equal to its allocable share on the top-up tax of wholly owned subsidiary in country C. And then priority 3 is that, where neither country C nor country X imposes, country C does not impose QD MTT and country X does not impose IIR. Well, then country A and B has implemented UTPR under globe rules. Now, wholly owned subsidiary 1 and 2, they shall be liable to pay, the jurisdictional top-up tax under UTPR in their jurisdiction, which is going to be this jurisdiction and jurisdiction. So they will pay UTPR. So first priority is QDMTT country C. Second is IIR country X. But third priority then is, UTPR country A and country B. Wholly owned subsidiary 1 and 2 in country A and country B, respectively. Now, there are a few more topics, that should be of, relevance as far as globe rules are concerned. There is something called as the effective tax rate. I think this is what I've been saying all this while, but they've just defined it. So the globe rules will operate to impose a top-up tax using an effective tax rate, and it's going to be calculated on a jurisdictional basis. If it is below minimum 15% rate, then the jurisdiction is treated as a low tax jurisdiction, and the constituent entities will be called as the low tax constituent entities. And this effective tax rate is going to be calculated for each, fiscal year. So this is, what they've provided here. Then there are some substance-based, carve outs out here. Then there is, something called as a top-up tax that we were, just discussing, right now. So this is, what is provided under the globe rules. And what I'm going to do is just quickly share the screen to, the slide deck that we were just discussing. Okay. So this is, the slide, that we were using to discuss everything. This is where we were discussing the latest developments in international taxation. And what we've done through this particular slide deck today is to understand these four chapters. We started with, the four chapters relating to BEPS, tax treaties, model taxation convention, and some latest developments in international taxation. So we started with basic concepts in international taxation, which was residence and source-based taxation. What happens if there's a collusion or a conflict? Then there's double taxation. There are these two types of double taxation, juridical and economic double taxation. We were discussing, tax treaties today. So, what are the two types of tax treaties? Why do we have tax treaties? How do we interpret tax treaties using VCLT? And the basic rules of interpretation of a tax treaty. Then we were discussing model taxation conventions like the OECD and the UN. There are obviously other like the US model, but we were concentrated on the UN model and the OECD model, and how there is a difference between the two, because OECD model advocates residence principle and the UN model advocates, or it gives more weightage to the source principle. Then these articles in the model convention, Article 1, Article 2, 4, which is definition of resident, then Article 5, which is permanent establishments, the different types of permanent establishments, then um, Article 7 on business profits, which is attribution of profits to permanent establishments, how much is attributed to the permanent establishment. So I mentioned for OECD, there is AOA, authorized OECD approach, which uses like a FAR analysis. And then there is force of attraction rules for UN for the purposes of attribution. Then we were discussing these articles on interest, royalties, FTS, automated digital services, very specific to UN, capital gains, IPS, independent personal services. We were discussing, the exemption and credit method under Article 23, and then MAP, dispute resolution, alternate dispute resolution mechanism under Article 25, which is MAP, exchange of information. After that, we went to BEPS and we were discussing these action plans, on digital economy, which we've discussed in detail, and, preventing treaty abuse, where they talk about LOB clause and, PPT, our action 7, and then discussing action plan 13 on, CBCR, master file and local file. And then we were discussing MLI, and covered tax agreements. And finally, the two-pillar framework is, what we were discussing, pillar 1 and pillar 2. And I think with this, we finish with, I finish with my presentation, uh, on these four chapters. I'm very, very happy to connect with you guys. And, using this particular QR code, you can use this to connect with me. I'm all the very best, for the exams. And thank you so much for the session today. I hope you were able to understand the concepts I was trying to explain. And thank you so much for the presentation. Sir, that's it. So session over. Thank you.